Hey, good morning, options traders. Well, I have a good question for the group. Can you make a calendar spread Vega neutral? Now, I'm sure some of you are wondering, first of all, what's Vega? And second of all, why would you want to make a calendar spread Vega neutral? Well, those are also good questions, but I'm addressing this to people who are calendar spreaders. It's a very popular strategy. And for those traders who use calendar spreads, a question that I get a lot is, can you make a calendar spread Vega neutral? And the answer is yes, but should you do it? The answer is probably no. So why? Well, let's go take a look. As always, please be sure to click like. Be very much appreciated and will go a long way into helping the YouTube channel. So as a quick refresher, remember what a calendar spread is. You're going to buy a longer dated option. Doesn't even matter if it's got 2 weeks or 4 weeks. Doesn't mean it has to have a ton of time. It just has to have more time than the one that you're selling. Then you're going to sell a shorter dated option with the same strike. Now both of these have to be calls or both are puts. They have to be the same type of options. You can't do one of each. And if you do that, you have a calendar spread. So as an example, let's say that you buy the April 100 call and you sell the January 100 call. So in this example, the one that you own, April, has more time to expiration than the one that you've sold for January. You've got the same strikes, both 100. You've got the right to buy at 100, the obligation to sell at 100. So assuming that these are at the money options, which is usually how your calendar spreads are initiated, it's going to be delta neutral, or at least very close. And that's because the position that you own will have about 50 deltas. The one that you've sold will be minus 50. And so you want this position to sit still. That's the outlook for a calendar spread. Stock's currently at 100. We want it to sit relatively quiet. The problem is that longer dated options have more Vega. So if you recall from the Greeks, Vega is the sensitivity to volatility. And because you've got the same strikes, that part isn't really affecting the Vega. It's the difference in time. And the one that you own has more time and therefore it's more sensitive to Vega. So the problem is that if volatility, let's say, comes crashing down, sometimes new traders say, oh, that's great because it's going to increase the value of my short position. Well, that's true, but it's also going to bang up, and I mean in a really bad way, your long position. And in most cases, if you get a big enough crush in volatility, the amount you lose on the long position is going to far outweigh the amount you gain from the short. And partly because a lot of times when traders are selling these short term, they might only be less than a week or 10 days. Might not have a lot of value to begin with. So if you're selling the option for 75 cents, that's all it can fall. But if the one that you're buying is $4 or $5 or $7, obviously it can take a much, much bigger hit. So again, because of this, a lot of traders have been asking, can you make a calendar spread Vega neutral? And again, the answer is yes, it can be done. It's really not all that hard, but you will see here in a second why it creates a very big risk that is probably going to be very much unwanted. So let's first find out how we're going to scale this to make it Vega neutral. So for example, let's say that we have a $100 call with 30 days to expiration. And according to a pricing model, it's worth $2.28. Now that same pricing model would tell us that a $100 call with 120 days to expiration, 4 times the amount of time, would be worth $4.57, would be worth double. And I think some of you recognize the relationship here. We've talked about it before, this square root pricing rule. We have 4 times the amount of time, square root of 4 is 2, so therefore these options, the ones that we own, should be twice as much, and that's what we're seeing here. Now that same pricing model is going to tell us that the 30-day call will have a Vega of 0.1143, and for the 120-day will be 0.2284. So another thing to notice is that these are going to scale out as well. These are usually from rounding errors, but if you have twice the option price, you're going to have twice the Vega. So these are ways that we could scale this. I could say that this option is twice the value of this and call this a scaling factor of 2. I could also look at the raw Vegas and say 0.2284 divided by 0.1143 is also a factor of 2. The problem is that these option prices and these Vegas are all ultimately derived by volatility. They depend on the volatility inputs that traders are using to generate these numbers. And so these are not going to be consistent across time. We could also have big skews, maybe in the short term, maybe in the long term. But to make things a little bit more comparable, traders will usually look at it in terms of time. Why? Because if one option has 30 days to expiration and another has 120 days, nobody can argue that there's 4 times the amount of time. They could certainly argue that this option is priced too high or this one is too low because of volatility. But they could never make that argument about time. So what we're going to do is to scale these according to time. And as I just mentioned, there is a square root pricing relationship here. So let's start with the 30-day option. So recall that whenever you are scaling volatility, it is always by the square root of time, as I just mentioned, but it's always in terms of a year. So how many years is this? Well, it's not even a year. It's actually 30 out of 360 days, or 1/12. So we take the square root of 30 divided by 360, and we're going to get 0.2886. Over on the right, we're going to take the square root of 120 divided by 360, or a third. You could also take the square root of 0.33, get about 0.5774. If we divide these two numbers out, 0.5774 divided by 0.2886, we get our scaling factor of 2. Now, once again, you might say, why go through all that trouble? We could have gotten that same answer by looking at the prices. Well, that's true, but again, we're not sure about the volatility that's being used here. We're trying to avoid letting these skews influence our calculations. And for the same reason, we can't just jump to conclusions by looking at the Vega numbers. So if we go to time, we can say for sure there should be a 2x scaling factor, so that we have, in terms of value, twice as much value because we have 4 times as much time. So for example, here's the same data. Here's our 30-day option, 228. Here's our 120-day at 457. Here are the Vega numbers that we saw. If we take the square root of time that we just saw, 0.2887 for the 30-day, and we get 0.5774 for the 120-day. If we divide these out, which is what we just saw, we get 2. So this is really the key, is it's telling us that we have twice as much value, or at least we should have twice as much value in this option here because we have 4 times as much time. We should have twice the price in the option. We should have twice the Vega. But once again, we can't rely on that in the financial markets, which is why we always resort to the time. So now we can see that we've got this scaling factor of 2. Well, now let's see how we can use that. First, let's take a look at a standard calendar spread. When you use a calendar spread, you are generally going to buy 10 and sell 10, or 5 and 5. It's always going to be in a 1-to-1 ratio. So just for the example, I'm going to use 10. It doesn't really matter. But if you bought 10 calls, it's going to cost you $22.87, which is just that number right there, 228 times 1,000. Why times 1,000? Because 10 calls controls 1,000 shares. We're scaling everything up by 1,000. What's your total Vega? It's going to be this Vega, 0.1143 times 1,000. So you would have a total Vega of, let's call it 114. What does that mean? It means if volatility ticks up 1 tick, let's say from 20 to 21, or from 37 to 38, whatever the current volatility is, it just notches up by 1. This position is going to pick up $114. It's a pretty big chunk of that number. What if volatility falls 1 tick? This position's going to lose $114. Now, keep in mind, as time and volatility and the stock price move, these numbers are going to change as well. But for right now, that is our current Vega. What about over here for the long position? Well, if we buy 10 calls here, we're going to take 1,000 times the call price, $45.72. We will take 1,000 times the Vega. We're going to have 228. So as expected, we have twice as much Vega. And again, this is where the problem is that traders have been asking about. If you get a big collapse in volatility, this number of the one that you own is going to lose a whole lot more than this position. So even though on paper it might sound like a good idea to have volatility fall, that might only be true for a short range. If it really implodes, it's going to be a negative to this position. Conversely, if volatility explodes, let's say from 20% to 30 or 40, 50%, then you might think, oh, this is great. And in a sense, it's true. Overall, the calendar spread will increase, but now there's more probability for that stock price to move up or down, which is a negative because that's not what you want the strategy to do. So if you happen to get that in the real world, that's usually a time you would just want to shut down the calendar. But that's kind of an aside. It's just showing that this position that you're long is far more sensitive to volatility. So again, as expected, the value of the long position should be twice that of the short. The value of the Vega should be twice that of the short. And that's because we looked at our scaling factor up here. And now that we have this information, the answer is easy. All we need to do is to make the short position twice as big. Why? Because its Vega is half as large. And so that should balance them out. So let's try it. Let's do 10 and 5. Now it doesn't matter as long as it's in a 2-to-1 ratio. But let's say that we're going to buy 5 and sell 10. So the 10 calls have a value of 22.87, same as it was here. Total Vega of 114, same as it was here. But take a look at the 5 calls now that you're long. If you buy 5 calls, you're taking 500 times this price, and that gives you 22.86, about the same as this. If you take 500 times your Vega, it gives you 114. Notice that your Vegas are about the same, and that's because the total values of the positions are the same. So now you've made it Vega neutral. So that's all good. It will neutralize your Vega, at least over short stock price movements and short periods of time and or movements in volatility. But there is a big danger. You can definitely make your calendar spread Vega neutral, but to do that you must have more shorts than longs. So this is going to cause, at a minimum, double damage. You've got far more short deltas than you have long, and it's a neutral position. But even more damaging, you've got far more negative gamma. A long calendar spread already has negative gamma. That's because your shorts have far more short gamma than the longs have long gamma. But you've just magnified it. And so that means in this case, if the stock price rises, you've got a massive amount of short deltas compared to your longs. And that's going to really cause massive damage if you end up getting into something like a GameStop that runs from 100 to 600. It could be absolutely beyond devastating, which is why it's really dangerous to do something like this. So once again, to answer the question, can you make a calendar spread Vega neutral? Yes, it's actually quite easy, but when you look at the big picture, the risks are generally not worth it. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the YouTube channel, Options A to Z Facebook Trading Group, and you can find a link in the description below.